I usually start my ETF screening process by finding the AUM leader and then giving a secondary consideration to their expense ratio. But did you see my analysis on the MOVE ETF? If not, it's right here. It turns out that the 8 cannabis ETFs share an annoying trait with those agribusiness ETFs. Even though they're labeled as cannabis ETFs, inside they're very different from one another. It's not apples to apples, it's more like joints to vapes to bongs to brownies. Big variation. So let's set aside the AUM and expense ratio screeners for a moment. Instead, I'll start with my 4 custom cannabis ETF filters. They're based on a few years of research and a little bit of inside knowledge I have of Cannabis Financials. First, custom screener, and this is a personal choice. I don't want to have a fund that has large exposure to grow generation. Right offhand, I don't know what percentage of the holdings that is exactly. I'll have to get in there and dissect the choices just to get a relative sense of what's too much. All of this because I think GrowGen is a big sell. Check out my video on it if you haven't already. I think GrowGen stock is a Venus flytrap disguised as a weed-like growth stock. Second, I want the same minimum exposure to IIPR, Innovation Industrial Properties. And feel the internet being mad at me right now as I trash 2 darling cannabis stocks. But why do you want to own that stock? Because they control warehouses and greenhouses and enter into long-term leases with cannabis growers who frankly might be out of business themselves in 3 years? Why don't we include cannabis greeting card companies in these ETFs too? They're about as important to legal cannabis as innovative industrial. Commercial growers don't need what IIPR is slanging. In fact, it's the other way around. Now, I fully acknowledge that the stock has been on an outrageous uptrend, but it's simply a REIT of warehouses and should be treated like that, not as a cannabis play. Which is a great segue into filter number 3, cannabis growers themselves, the pure play businesses that grow the cannabis flowers. They are high risk investments and should not be the majority of anybody's cannabis allocation. Here's why I think that. Growers don't control their own destiny. Think of them as producers of a commodity. Certain nations and OPEC only make a profit if oil is above a certain price, right? Cannabis growers are no different. For one, the market dictates the wholesale price of cannabis to the growers, and that wholesale price combined with the costs will determine whether or not they're profitable from month to month. The destiny is not in their hands. But just as impactful as that price of cannabis is to the growers, the other players in the cannabis chain roll their losses downhill, right into those growers. Check out these 2 different hills and who sits at the bottom. At the top of one hill, we have cultivation suppliers, Scott's Miracle Grow, or more specifically, Hawthorne, Hydra Farm, Fox Farm, Groden. I'll even throw in GrowGen in to keep the internet happy, as if they aren't just a sheep in wolf's clothing. The common link of this hilltop is that there's only a handful of firms here producing cultivation supplies, and growers are dependent upon them. These cultivation supply companies dictate pricing downhill to the grower. When these suppliers raise prices, growers hope to pass along those increases onto the buyers of their harvested cannabis. Of course, those buyers are more commonly known as retail dispensaries, but look closely at the other hilltop. That's where the retail side of cannabis sits. Those dispensaries and Weedmaps too. Remember, Weedmaps is the DoorDash or the e-commerce play on legal cannabis. As Weedmaps skims the dispensary's profits, those dispensaries will try to make up the loss by lowering their wholesale offer to the growers. That's 2 different industries deciding for the growers how much profit they deserve. Remember, we're marching toward legalization. That's why you're here, to learn about cannabis investments in the first place, right? As we get further into this reality of fully legal cannabis, more and more new growers will come into operation in more states, and eventually growers will be shipping legal cannabis across state lines into other growers' territories. A high volume Texas grow op with good margins could start to gain market share and the 20 coldest states, for instance, where growing cannabis is more costly. Just one hypothetical example of how dispensaries will have an influx of new growers to buy from and will have the power to dictate prices downhill as the oversupply blooms. And how many years really do you think is going to take before there's a national oversupply of cannabis? Once cross-state sales are legal, a couple years, maybe? Remember, they're growing weeds. Weed. Growers with weak margins won't survive. That could be farms with 1,000 square feet of canopy or 1,000,000 square feet. Margins at the time of oversupply will be the only differentiator. Just like any other business sector when there are too many manufacturers compared to the demand. Now, my crystal ball is on back order because of the semiconductor shortage, which means I can't predict today which growers will be standing and which will fall when that oversupply hits. That uncertainty means we should proceed with caution in the grower segment of cannabis. I want broad exposure. It's certainly a piece of the investment pie, but they need to be a small portion of my overall cannabis allocation. Okay, you're still with me after those 3 filters? Here's my 4th and final custom cannabis filter. I prefer extra exposure to pick and shovel plays. The 3 I'm most interested in are Weed Maps, Scott's Miracle Grow, and Hydrofarm. To earn my stamp of approval, these cannabis ETFs will need to have exposure to these obvious pick and shovel choices, which I think will outperform the growers when we look far enough into the future. So there we have it, the custom filters. Easy on the GrowGen, easy on innovation industrial, not overexposed to growers, and heavy on pick and shovel plays. Next, I'm going to apply these custom filters to the 8 different cannabis ETFs we get to consider. 2 of them are branded as specifically US cannabis investments, and the rest are broad plays of the sector. Because you've seen my other ETF videos, you know that I like to start with the AUM leader and work my way through the rest. The Alternative Harvest ETF is the pace setter of this space with the oh so subtle ticker symbol MJ. Yes, as in Mary Jane. It was the first US listed cannabis ETF, debuting all the way back in 2017. It was revolutionary at the time because it was the first easy way for American retail investors to get exposure to legal pot companies on the Toronto Stock Exchange. It had all the big players, Canopy, Aurora, Kronos, before these companies had a US listed counterpart. Going through the holdings today in 2021, GrowGen is one of the top positions at 8%. There's 4 or 5 big tobacco companies, depending on how strict you want to be in defining what a tobacco company is. These tobacco giants have been a part of this ETF going all the way back to 2017. It's always been a black eye of the fund, but early investors looked the other way in exchange for access to the Canadian growers. But just like that, even without doing much of a deep dive, 20% of this ETF is a major bummer, dude. GrowGen and big tobacco, this one's not for me. Let's also eliminate the Toke ETF. Again, real subtle, right? They're from Cambria and eliminated for the very same reasons. IIPR plus a few tobacco companies accounts for 20% of its holdings. And look, I don't have my head in the sand. I realize these tobacco companies have maturing positions in big cannabis entities, but it's like innovative industrial all over again. It's not how I want to capture profits in this space. Take a look at another ETF, YOLO from Advisor Shares, 0.75% expense ratio and a healthy 350 million in AUM. But innovative industrial sits at 10%, GrowGen at 6%. I'm immediately hesitant. Also, no Hydrofarm, no Scott's, no Weed Maps, but they've included GrowGen in there. Justify that for me, including the middleman instead of the suppliers. This ETF eliminated from contention as well. Eliminate THC X2, an ETF from Innovation Shares. It's not that the holdings are bad, they're decent in fact. I just can't find a single piece of information about Innovation Shares online. The website they list on LinkedIn redirects you to some other financial company website. It's too murky for me. I'm out. In this field of cannabis ETF choices, MSOS and MJUS stand out as being the only 2 US focused funds. But when I think of American cannabis companies, I tend to think of them as underdeveloped entities sloshing around in a frothy, immature market. In fact, I think cannabis will eventually be a lot like the soda market, where we have two main players like a Coke and a Pepsi, and a fleet of less relevant players buzzing around without making much noise. What if I told you that the Coke or the Pepsi of American cannabis hasn't even been founded yet? I really, truly believe that. I don't know that the champion brand or firm that we'll all see as the Pepsi of the space in 2040 is even off the ground yet. So investing in these US only funds is just too speculative for me right now. So scratch them from the list. And after all that, we're left with just CNBS from Amplify and Pot X from Global X. I like both of these ETFs in certain situations. Both have tactical uses depending on the rest of your portfolio. As a side note, comparing these two ETF issuers, I know virtually nothing about Amplify as an ETF issuer. They seem like a small outfit overall. Both iBuy and their blockchain ETF pop up in conversation from time to time. Okay. Global X, on the other hand, I think you could make the case that they are the kings and queens of thematic ETFs. You know, when you're at that one friend's house and you open their fridge and they've got 14 different types of beer. That's what the Global X's ETF choices are like. They've got ETF themes on uranium and the aging population, and even a fund of all founder-led companies. You name a theme, Global X has figured out how to assemble it. So I'd guess they can skillfully assemble a cannabis ETF. Their ETF ticker is POTX. It's got 200 million in assets and the second lowest fee of any cannabis ETF at a very reasonable 51 basis points. It is loaded with cannabis growers almost exclusively. No Hydrofarm or Scotts or Weed Maps, and Sundial. The top holding is one of the meme mania stocks, which should be a red flag to us, and it is. I don't want some misvalued meme stock hiding in an ETF and throwing off my investing results. But set aside the Sundial concern for just 1 second. What if I suggest something off the wall here? What if I make a custom portfolio for cannabis exposure? I do something like 33% Weed Maps, 33% split between Scotts and Hydrofarm, and 33% PotX. Checks off my original goals, doesn't it? I get access to my 3 favorites in the space by holding their stocks, while also getting tactical access to growers at a much reduced exposure level compared to holding any of these ETFs exclusively. And bonus on the top, I avoid GrowGen and innovative industrial altogether. What do you think? Let me know in the comments below. But look, if that isn't for you and you'd rather have an ETF manager jockey the whole cannabis space around for you in a neat ETF, I respect that. I do that in other sectors all the time. If that's you, CNBS from Amplify is a great choice. The top holding is Weed Maps, a play I love and that most other cannabis ETFs don't even include. Tim Seymour, who's running this thing, must have a good eye on where future outperformance is if he's willing to go that big a wager on Weed Maps. Yeah, GrowGen and Innovative Industrial are in the top 10 too, but so is Hydrofarm. And down the list, I don't see any obvious tobacco companies hiding out pretending to be cannabis players. So CNBS isn't perfect, but it is the best all-in-one cannabis investment you can make right now because they respect the value of pick and shovel plays more than the others. CNBS and a few shares of Scotts Miracle-Gro on the side, and I think that would make for a solid long-haul cannabis fund. What do you think of these choices? Do you like one of the ETFs I passed to the left better than one I landed on? If you're confused about any of this, I urge you to check out my videos on Weed Maps, on Scotts Miracle-Gro, and my warning about GrowGen. You'll be caught up in no time. And I'll catch you on the next one. Well, another pot analysis. It definitely feels like we're in nascent times for this industry, at least from an investing perspective. It'll be interesting to see how the investable products change over the years as these companies become more mainstream. All right, I will see you guys later. Thanks. Bye.